We're here with JC, and JC, do you want to introduce yourself
Sure,
briefly?
sure. So my name is JC. I have a YouTube channel where I talk about options. I share basically everything that I do, my processes. I show my results, what works, what doesn't. And I'm really glad to be here. And thanks for having me on your show.
Yeah, it's my pleasure. And my name is David Jaffe, and I have the channel BestStockStrategy.com. I stumbled upon JC's videos regarding options trading. I felt that he was very genuine in giving advice, documenting his journey, what worked, what didn't, some strategies that he's employing. And I think it's important to increase awareness for those types of people who are teaching high probability trading, but at the same time, teaching people how to avoid the rough patches and how to avoid taking large
Mhm.
losses during the 2 to 3% of the trades that where actual volatility ends up being higher than the
Yeah.
expected volatility. So let's get started. And you had a question regarding watch lists.
Yeah, yeah. I think watchlist is a good is a good segue into it because for example, when you just mentioned about having those 2 to 3% moves, just ripping option sellers, usually, and that's something that I've noticed, and let me know if you agree. That'd be interesting to have your point of view. Usually, really comes down to choosing the stocks that you're going to trade. And I felt personally that everything changed for me when I started focusing on, a couple of stocks, or at least a watch list of stocks that are made of stocks that are, quality companies that have, like a business model behind it, and that is a proper stock, and not something that is completely hyped by everything that you see around. For example, AMC, GM. If I had, like, a good example is, the difference between trading a solid company like, I don't know, like Lockheed Martin and AMC, for example. I don't know what's your view on that.
I completely agree with you. I keep a watch list of about 10 to 12 companies. And one of the huge advantages of that are that you actually don't have to spend any time reading any press releases or doing any research. Because when you have a company like Amazon or Apple on your watch list, there is absolutely nothing that you're going to read that's going to help you make a better decision that's not
Yeah,
already priced into the stock, into the current market price. So I think that it's very efficient, not only from a liquidity standpoint, not only from a narrow bid ask spread, but also it saves you time and it's less gambling. I think perhaps most importantly, you know that 4 or 5 years from now, there's an incredibly high probability that a stock like Amazon or Apple or Facebook is going to be trading at a higher level than it is right now. And
yeah,
if it's not, then it's going to probably outperform a stock like AMC or GameStop over the next 5 years. So I think that doing something like selling options in like highly liquid large cap companies, not only are you protected, get comfortable with the trading range, and you don't have to do a tremendous amount of research, but also there is an inherent bias that it's going to go up. The biggest problem that I see is that they don't move as much as something like GameStop or AMC. And human beings inherently are attracted to making easy money. So if you can make 3% a month from trading puts and some calls on Amazon, and then you can make 3% in one day from trading AMC and
for
GameStop,
sure.
and people are telling you that they just made 100% in GameStop on call options in just a few days, then it increases your desire to want to gamble and want to dip your toe in and your temptation to engage in bad behavior.
Yeah, absolutely. And the thing is, I watched like your interview that you did with Shiba's from the YouTube channel Shiba's blog, and you were mentioning something that I fundamentally agreed with you, is that, for example, when you have some of your students who tell you that they've reached like a certain percentage of return per month, like 6-7%, it's actually not necessarily a good thing, because it
Yeah.
shows that you're taking too much risk. And And it's funny because this is something that I came to think about, is that basically any return is possible. It's more how sustainable is that return versus how doable is the return. Because of course you can make 100% in a day. Like you could technically, if you gamble and you're lucky, you might make 100%, but you cannot make that again and again. And sooner or later, you're probably going to lose money. And that's something that really, it took me a long time. I mean, I don't know about you. I understand that you've been trading options for 11 years, if I'm not mistaken, for a long time. And, you know, at first for me, I tried everything. I tried like everything that you can think of. Every video that you review on your channel, like I've been a victim of all these people combined, you know. And it took me really a long time to understand what is a doable return, what is, you know, like what is a return where you can take enough risk so as to actually be paid for that. Because when you want to be paid for the risk that you're taking, and also not putting yourself in a position where you're too exposed. Because, for example, if you sell naked options on a stock, you know, that has a great implied volatility, that's nice. You're going to make nice returns. But, you know, the day where there is a crash, and that's for sure that there's going to be a crash that's going to happen, you're going to be, you know, wiped out. And that, I think that's a good segue to what's for you an achievable return that someone can do per month. I have my idea of based on my performances and everything, but I want to hear your opinion.
Okay, so I think it's on average, it should be about 3 to 3.5%. However, I think that during periods of low implied volatility, when the VIX is really low, like right now, when I think on Friday, the VIX fell below 15, it hasn't been that low since early February of 2020. During periods like right now, it's actually incredibly dangerous to trade because you feel very antsy, since long equity holders are actually making more money than selling options are. So I know that for myself and for some of my students, I feel a lot of pressure to make trades where I don't feel that they're good trades and they're not trades I want to make. So right now, maybe I'm making like 1.5%, 2% a month. And I'm completely okay with that because I know that if the market pulls back 5 to 7% or potentially more, and then the VIX spikes up above 20, I'm going to make about 4 to 4.5%. And the higher the VIX goes, the more money I'm going to make, as long as I'm disciplined. But if I make trades right now to try to, with a low implied volatility and with a low VIX, to try to chase that return. So instead of 1.5 to 2, if I'm trying to still make 3.5 to 4, then if the VIX spikes, then I will end up losing out on those opportunities because I'll have to defend all of my existing trades. And I think that right now is probably one of the more dangerous times that we've had over the past year to almost a year and a half in the entire stock market, because nobody likes to feel left out. And right now, long stockholders are making more money as of, you know, the July 4th holiday in 2021. Long stockholders are making more money than option sellers. And a lot of people don't like that. They get very antsy. And it's very dangerous because those options with strike prices that are too aggressive, they start trading too large. What are your thoughts?
But especially like when you tell me, for example, about the fact of staying disciplined, I feel it's like, you know, there's a lot of things when it comes to selling options. Obviously you have to be engaged so as to make money. You have to take risks so as to make money. That, you know, that's natural. However, you obviously have to stay disciplined, especially during those times, which I absolutely agree with you. I think it's the most dangerous times, because it's when nothing happens that is the worst, because when that volatility is going to come back, the options that we will have sold, they will actually be like super close to the stock price, and you know, we will see new volatility coming in, and we'll get our positions crushed. And I guess when you send, for example, alerts, that might be a bit tricky for your students, because if obviously you're not going to put trades on that you don't have any business to do with, but they're going to be like, well, I'm paying you, so you send me alerts, so how is that working? Except that it's also, I think, part of the game to really stay disciplined. And, you know, on the one hand, I love trading. I love to put trades on. I am always eager to be on Monday, you know, to have the markets open and everything. But for example, this week, I haven't put any trades on. I don't think I've put actually any trades on. I just watched my trades the whole week. And on the one hand, when I, for example, listen to Tasty Trade and they put so many trades on, it's insane the number of trades that they put.
Yeah,
I would love in a way to do that. I would love in a way to be able to be so active. However, I know that, I mean, I don't know how they put so many trades on, but I know that if I do this on my account, I'm going to start putting trades on underlyings that I shouldn't put trades on. And that's going to cause me sooner or later to lose money. So right now, I think it's mostly a game of, you know, discipline and who's the most patient and who's willing really to sit on the sideline and wait for you know, the good opportunities. And you know, coming from like during 2020 and beginning of 2021, I mean, that was amazing to sell options during that time. Like, I don't know about you for 2020 and so far 2021, but with the VIX going down, I mean, it was like surfing that wave of volatility contracting, and that was really nice way because a lot of trades, for example, that I've put on, I usually try to keep a portfolio that is quite delta neutral. I'm obviously a bit biased on the upside because I believe that on the long term, especially for solid companies, those stocks are going to tend to go up, to grind up. But I'm still trying to have some cold credit spreads on because I don't want to be too heavy on the long side. So I'm trying to have also some cold credit spreads on. And even if, you know, you are not necessarily right in the direction, let's say that you sold the cold credit spread that is like, let's say, around the 30 delta, you are still going to make money during this time where the volatility is contracting because, you know, option prices are getting cheaper. And if the stock is not going too much against you, if it's going a bit against you, you're still going to make money. And worst case scenario, you just roll it to the next month or for 2 or 3 months, and it's probably going to come back at some point just with the volatility contraction. And honestly, so far, it's been quite crazy 2021 because I don't know what you think about this, because basically you could have basically put any trades on like for overextended periods. You know, when the stock gets too overextended on the upside or on the downside, if you start selling a put when, you know, when the stock falls a lot, you're almost sure that you're going to is going to work out at some point. And that's why I'm definitely a big advocate of selling options. And you know, I'm not necessarily like if I see that buying options gets better at some point, I'm out. You know, I'm going to start buying options. However, I've never ever seen, for example, that the counter example of buying options actually works better than selling options, except if you go for you know, strategies like Nassim Taleb, where he's going to buy those very far out the money puts, and once every 5 years he pays out, like I've seen in 2020 he had done a return of 2,000, 3,000%. But is it really worth it? I mean, personally, I'd rather sell options.
I actually don't think that we're going to experience something similar. And I said this in my video with Shahib. I don't think that we'll ever experience something similar to 2020 again in March 2020. Maybe we'll experience something that's like 70% of that, but I just don't think that and I know that making a future prediction sets me up to look like an idiot in the future, but at the same time,
I hope you're right.
Yeah, the violence of March 2020 was so extreme. I think that we might see something where, and it happened where the market fell like 36% in 33 days. I mean, that's something that's unheard of. In 2008, it fell a larger amount, but it fell over the course of like almost a year and a half. So I don't think that the volatility per day will approach that. But you brought up something really interesting. So quickly regarding Tasty Trade, and then we'll talk about like selling both sides and like delta neutral. Similar to you, I believe that Tasty Trade is an amazing resource. Now, I think that Tom is also incredible. He responds to all emails. I think that he has great intent. However, I also think that he is incentivized to encourage people to trade often because he is one of the primary owners of Tastyworks. I don't think that right now it is in people's best interest to trade often, especially with low IV. And whether you're trading calls, I also don't think that right now it's a great time to sell too many calls. And the primary reason is that the best time to sell call options is when the market is in a euphoric state. And I think that right now the market is high, but I don't necessarily think that it's euphoric, right? Like Amazon, Facebook, Microsoft, Apple, they're at or close to their 52-week high, but it's not like they're trading at 10% or 15% above their 52 or their all-time high. It's not like that much euphoria. Like Nvidia, maybe, but I would probably feel a little bit better if Nvidia went up an incremental like 5 to 7%, and then I would feel more comfortable selling like an 1150 call option or like a 1200 call option that expires in like 3 to 4 weeks. So right now I would be pretty careful on both the put and the call side. But I also think that one other issue with Tastyworks and Tasty Trade is that with low volatility, if you put on a tremendous amount of trades and then VIX increases from like 15 to 25 or 15 to 30, that inherently is incredibly stressful. So if you have 20 to 30 positions on, not only is it depressing because you're losing money, but it's just overwhelming for you to go through each position and look at the charts and then look at all the options, look at the bid-ask spread, and roll each of those positions. I think it's much better to keep a very tight watch list and be disciplined and realize that, okay, so you'll sacrifice a little bit of money right now, but have confidence that you will make up that money and you'll save yourself stress on the back end once the opportunities fall in your lap. And I made one trade, I believe this past week. I think it was like one new opening trade on the put side. I remember when Amazon fell to about like 3,400 and I sold like a 2,500 put strike, and I figured, okay, I have portfolio margin. It doesn't really use up that much incremental buying power, and I picked up like $350 per contract. And I figured, okay, in the worst case scenario, I can roll this position. But I right now am actually quite delta neutral. Like I have a lot of call positions on. I do have an Nvidia call. I do have, I think I have a well, I know I have in Amazon, like some Amazon calls. I have some Tesla calls as well with a strike price of about 900. And I wanted your insight. What I do with calls is because the market has an upward bias, I tend to shorten up my durations. And I tend to go even further out of the money when selling calls because I know that, like I said earlier, the market has an upward bias. So I want to sell something with an expiration of like 2 to 3 weeks out for a stock that I believe is overextended. And I want to sell it further out of the money than I would on the put side. The good thing about selling calls is that you don't necessarily, there's not like significant, unless you're trading like GameStop, as long as you trade small enough and you don't trade too many contracts, even if the call options get challenged, you pretty much know you're going to make money when you sell calls as long as you roll it. Because if something's overextended, okay, maybe you mistime the trade because no one can guess future price movements, right? Like we don't know. We're just placing educated guesses really like on where we think something is overextended and where it's not. So even if you're a little bit wrong and the stock goes up an incremental like 10% and is slightly in the money, okay, that's fine. So it goes, you roll it out and eventually it'll be profitable. On the put side, it's actually not like that because on the put side, if the market sells off like it did in December 2018 or February 2018 or August 2015, that put option can actually fall like 25-30% in the money, and with a high and a large volatility expansion, so you get double whammy, and that could actually be problematic.
That's for sure. I mean, selling calls is always a pain for me. Honestly, I don't like selling calls. If I could stick to selling puts only, I think I would rather just sell puts. But, it's nice to have a delta neutral portfolio because at least you're going to benefit. And as you said, you might be wrong on the short term. On the short term, for example, I had like a call credit spread on GDX XLF that went wrong. I just rolled them by 1 month, and they went back in profit. And usually what I do is when I roll my trade to the next expiration, if I get back my loss from the previous trade and a bit of profit on top of that, I'm out. I'm usually just focusing on getting back the money that I lost and a scratch on top of that, and then I'm out. I'm not trying to get another profit or another, trying to make 50% or whatever it is. I'm trying to get back the money that I lost, and then I'm out. But for the put side, and I think that's a very recurrent thing, and I think you need to have gone through something bad to actually always think like this, is that we are always thinking in terms of crush. We are always thinking is the worst case scenario. And
we win such a large percentage of our trades, but I'm still always thinking, oh my God, what happens if this is the one trade that screws me over? I always think about, okay, what am I going to do if I lose money on this trade?
And you freak out so much for a crash that will probably won't happen until years later. But that's the thing is, like, the emotional pain that someone goes through when their positions all go in red and you have to either roll them or you cannot roll them because whatever reason, your brain fries, and that's why also I agree with you when you said that having too many positions, especially in a low IV environment, is insane, because the day where it goes wrong, not only you will have to manage all those positions, but the mental toll that you will take seeing all that red and seeing all that money just like leaving your account. Honestly, it's a lot to take in, and I think you need to go through that once, be hurt like a lot, and then after that you're vaccinated. You know what to do, and at least you're going to think about the crash every single time when you put a trade on. And I think it comes down to, and that's where I think tastytrade has made their biggest impact, is watching the position size. We always need to check our size, and especially right now, how many times a week I'm tempted to not sell, like, for example, 1 contract, but just sell 3 contracts because I haven't gotten a lot of returns, for example, in June. So I'm like, yeah, maybe I could try to pump up those returns by selling a bit more contracts. But I know that it's by thinking like this that I'm going to get burned at some point. And that's why, for me, I think it's really a game of staying disciplined and making sure that you keep your size to what you can really afford, because it's so easy to get overwhelmed by the feeling of, for example, like cryptos. Like, everyone who invested in crypto, of course, that's great when everything is going up, but at some point it's going to come down. And something that is going up like 7% a day, it's not healthy at all. That's why I'm not trading market leaders, because usually you need to have like a ton of buying power available for each and every single position. So I'm going to trade, like, for example, stocks that are around the mid market a bit. They are still good within the sector. They are not crappy stocks, but they are good, solid companies, just not market leaders, because market leaders cost a lot of money. And it's doing great. And I'm just staying away from AMC, GME. I mean, I traded AMC. I bought some shares because I thought it was funny. But that's the only thing that I'm going to do with AMC. I'm not going to start investing really my money and trading it as stock. Yeah.
Do you always strive and target a delta neutral position, or are you only delta neutral now because the VIX is very low?
So I try to at least have some cold credit spreads on, at least all the time. All the time I'm going to have some cold credit spreads on. However, right now, I think if I look at my positions quickly, I think I am, I'm still biased on the upside, but I usually try to always keep a delta neutral portfolio, at least having some cold credit spreads on, because I just want to be able to benefit from a potential down move.
Okay, so if the VIX is like 35, then I'm assuming you'll have some call credit spreads, but you'll be more biased towards puts. And okay, that's what I would do as well. That's great.
Because the problem is, for example, if there is like a crash that happens, I think a mistake could try to still be delta neutral when, for example, the market bottom. Because if the market is at its bottom, it's probably going to go up. I mean, if you look at 2020, if you had sold like a call credit spread in March, you would have literally sold at the lowest of the lowest, So, for example, if tomorrow a crash happens, I'm not going to stay delta neutral. I'm probably going to sell new puts, new put credit spreads on or new naked puts, but I'm going to be careful in selling calls because obviously the market is going to fall, and then after it's going
the risk.
So
yep.
yeah, I think being delta neutral is nice in this type of environments when nothing is pretty much going on. But during a crash and after a crash, we need to be really careful about selling call credit spread. I got burned in 2020 because of this. I was, first of all, in 2020 after the crash, I thought that the market was going to continue going down, even though it was already down like crazy. I remember seeing the charts on a daily basis. You see the stock market losing 3% in a day. I mean, that's shocking, like
one
that's
day like March 16th or something, didn't it lose like 10% or something? I never seen something like that. It was nuts.
It was insane. It was insane. I was looking at my phone. I was literally standing in the street. I couldn't even believe looking at those numbers. And, the thing is, I was convinced that the stock market would continue going down. So I kept selling new call credit spreads on. And, as a result, I just got burned. Because the market just went up no one, I mean, personally, I didn't expect the market recovering that fast. And on top of that, not only recovering, but also literally surpassing all of the previous all-time highs. Yeah. And that's a crazy thing. And that's why I disagree with you a bit when you said that, for example, we are not in a euphoria market, because when you look at where the market is, and after that with the US, it's maybe a bit different because I'm obviously comparing to Europe maybe, and the situation with COVID and how is everything. Maybe in the US, it's too different compared to Europe, but I still think that the market is overextended. And I think that in our lifetime, I think they'll be worse. I think that they'll be worse. And I mean, it's a bit the safety choice of saying that there will be worse, but when I look at all the money that has been printed, and in the whole world, not only the US, in Europe also, when we look at how the businesses are surviving right now, all the money that has been printed, it's just putting the problems for later. And I'm just wondering, when is that bubble going to pop? And so that's why it's a matter of making sure when it comes to trading, to make sure that we are protected during this type of low IV environments. So I guess, watching a bit your videos, you're selling credit spreads mostly in low IV environments.
Yeah, and that's actually something I wanted to ask you. So if so are you selling naked, like right now, are you selling naked puts, naked calls, or naked or vertical credit spreads, or call spreads, or it depends on the underlying? And secondarily, what I'm really interested in is, are you selling calls on the same positions that you're selling puts on? So are you turning them into strangles or iron condors, or are you more opportunistically, like what I do is I'm thinking, hey, NVIDIA is up X%. I think that NVIDIA is overextended right now, and there's a decent amount of premium available on the 1100 if I sell this position that expires in 3 weeks. So I want to sell just this call or this call spread, and it's going to lower, or rather it's going to decrease my overall delta for my overall portfolio. So that will allow me to then sell a put on something like MasterCard like 2 or 3 weeks ago, when I thought that it was a little bit overextended to the downside. Like, what are your thoughts on that?
So to answer your first question, in this type of low IV environment, so I'd say whenever the VIX is below like 25 or something, I mean, 25 is already high, but let's say right now, I'm only going to sell call credit spreads and put credit spreads. I'm only going to stick to credit spreads, and the way I structure them, I'm going to sell wide credit spreads. So usually, talking about deltas, I'm going to sell, for example, the 30, 35 delta, and I'm going to buy, usually I'm aiming for the 5 delta for the long leg. And the reason I'm doing this, there are several benefits to doing this, is that, first of all, I'm keeping most of the premium that I'm selling, and the long leg that I'm buying, yes, I have potential max loss that is big, but that long leg is really there as an insurance in case of a crash. And we always come back to the subject of a crash because it's really what, unfortunately, it's all about. It's about protecting yourself when things go wrong. And that long leg is really there for that. And another benefit of that is that by selling a very wide credit spread, if the trade goes against me, which happens, well, I can still roll it quite easily. And it's not, I was listening to your previous interview with Shiba when he was saying, yeah, it's hard to roll credit spreads. Honestly, it's not if you make it wide enough. If you make it wide enough and consider it really as an insurance in case of a crash, it's not hard to roll it because the long leg is going to cost a few cents compared to the short leg. If you sell and there's a good IV, it's going to be at least $1 or something. Well, it's not going to be a pain at all to roll it. It's actually very easy. And in the worst case scenario, I that's probably something that we'll do in the next crash. Even if I cannot roll for credit, nothing prevents me from at least taking the profit from the long leg and just rolling my short leg into the next expiration, because at least I'll have mitigated the potential loss that I would have had if I hadn't bought that long leg. So
well, you could, sorry to interrupt, what you could also do in like the worst case scenario, let's say you have $100 wide put spread, which you could, so that's like a box, right? You can actually roll that position down, extend it from 100 to 120, decrease the short put strike significantly. Let's say I'm thinking about like Amazon. So let's say you sell like a 29 by 2800, Amazon falls to like 25. You can increase the width from 100 to 120, roll that down from 26 to 2480, right? Where it's significantly oversold. Then if you want to actually profit on the upside, you can actually roll up the short put strike from 2600 to 2800. Then you would capture both the intrinsic and the extrinsic. And then as Amazon increases in price, you can actually make money and participate in the upside as well. So I do really like credit spreads, and I agree with what you're saying as well.
Yeah,
that it's
and
easier to pull it when it's a little bit wider.
I mean, after that, naked puts there. I mean, that's, if I could only sell naked puts, I would love to, because you reach your profit faster. I mean, you collect more premium. What else to ask? However, I think it's our duty when you manage either someone else's money or your own money to make sure that you're not going to lose that money. And the way you're not losing that money is by making sure that you protect it. Unfortunately, if you sell naked options during a crash, you're not going to be protected. And like when I see, sometimes I'm sure you see the same things. Sometimes I see people selling hundreds of contracts.
It's great when you make so much money and think you're untouchable, and this is one of the most important things. As experienced options traders, viewers should learn from our experience because we've made mistakes and we've lost money, and no one is untouchable. Everyone makes mistakes, and it's better for them to learn from our mistakes than to think that they can consistently earn 5 to 7% a month, because it's only a matter of time if they're striving for those type of returns. Hey, I would love to make 7% a month.
Same.
Why would I not want to make that amount? It's just that the risk and the stress that goes along with that is not worth it.
Yeah, exactly. And to answer your second question on how, for example, am I going to sell those credit spreads, I'm going to exactly say do what you say, going for a more opportunistic approach, meaning that if I see that a stock, and that's something that is very simple, but that works pretty well. If you see that a stock is, let's say, is at $100 and usually it's trading between $120 and $80. If you see that it's falling around 85, then my theory, my at least hypothesis, is that there's a pretty good chance that it's not going to stay there. So that's where I'm going to sell a put credit spread when the stock is at the low end of its, let's say, monthly to month trading range. And by doing this, I'm just basically betting that the stock is going to come back where it was before. And that's, and when it's on the call side, it's exactly the opposite. And the call side is where it gets tricky, because obviously with the stock market being biased on the upside, you know that there's a good chance that on the long term, it's probably going to go past that level. But on the short term, usually stocks are overextended. So same thing on the call side. If I see that, for example, a stock that is trading between 80 and 120 gets to 115, then for me, it's a nice opportunity to sell a call credit spread. The problem with that, with selling call credit spread usually, is that as stocks go up, they lose premium, they lose that volatility. So it's going to, especially now, we're making less and less money with the VIX going lower and lower. But, that's also the role of the game, and that's just how it is. But that's basically it. That's crazy, because I literally break down everything, all of my strategies in my videos and everything, saying exactly that monthly range. And I'm just like, it is that simple, you know. And of course, I could still lose money on a single, you know, stock and everything, but that's mostly it. And sometimes I think that it's actually quite funny because it's hard. Honestly, it's been one of the toughest things that I've had to learn. That's, you know, for sure. But once you actually understand a bit the mechanics and you understand how to roll your trades and how to, you know, postpone a bit that loss, and then it comes back and you actually experience it 1, 2, 3 times, well,
Then
you know, you start getting it.
You're like, okay, I can handle this. You gain confidence.
Yeah.
How many stocks do you have on your watch list, or stocks or ETFs?
So funny, because I was actually counting the other day. I think I have between 20 and 30 stocks, something like this. I have like, yeah, maybe closer between 30.
When you sell a call, you will sell it and look at it from an overall portfolio delta. You'll look at your overall portfolio delta. So if something is overextended on one security on your watch list, then you'll sell a call. But then if something is overextended to the downside, you might sell a put. So you're not trying to match up from a strangle perspective and force a trade, because inherently, like you said, where you're looking at like the low end of its range in like a month or 2 months, if it's a great time to sell a put, then inherently it's a bad time to sell a call.
Exactly.
You experienced in like March 2020, because you thought that the market was going to keep going down, but then it jumped back up and you were selling calls, and then it increased. That stock probably increased like 10 to 20%, and then you got whipsawed, right?
Yeah, exactly. That's exactly that. And you know, strangles, for example, I think it's one of the strategies that blew my mind the most when I started looking into options, because I was like, damn, so I don't need to actually bet on the direction. I can bet that the stock is staying where it is. And usually when I talk to options to people that don't necessarily know about options, that's usually one strategy that I mentioned, because, you know, to show them actually how powerful options are. But now when I use strangles, it's mostly for earning trades. I'm almost never going to trade use a strangle for, you know, a more portfolio basis. And to what you were saying, that's exactly right. I'm going to look at my overall portfolio usually and try to, you know, for example, if I'm too loaded on the put side, I'm not going to sell another put, you know, because I'm already loaded on the put side, and I don't want to be too heavy on the put side. So I'm going to try to look for something on the call side. And sometimes it's a pain. Sometimes I spend like 1 hour, 2 hours, you know, just in front of my computer procrastinating to find a trade. But, you know, I'd rather do this because it's working rather than just throwing money in the market and hoping it comes back, because when I tried, it didn't work.
All right. So let's say Apple, because that's about like $140 stock around there. So that, let's say Apple is trading at like 140, and then let's say this upcoming week it falls to 128. So there are, in the way that I trade, if it fell to about 128, I would look at pretty much two trades. I would say, okay, I can sell, and then I would take into account that there's earnings, I believe, in like 3 weeks. And I would also look at like the overall market. But, you know, in general, I would say, okay, Apple's at 128. It was last week trading at about 140. I can either sell a 105 naked option, 105 naked put, to expire immediately after, like that Friday after the earnings announcement, and collect, I don't know, maybe I would collect $1.50, like $1.75, something like that, because you get a bump up in IV from the $12 fall in Apple, and then also from the earnings. Or I could sell a 115 or 117 and a half by 110 vertical credit spread. So your choice would be either a naked 105 or a 117 by 110 vertical credit spread. And for that, maybe you would collect like 75, like that. But which one would you rather do?
Yeah. So the way I trade earnings, I'm not going to trade it, for example, in your case of Apple, I'm going to go for the credit spread. And the reason for that is that the way I'm going to trade earnings, it's very, very, you know, broken down to black and white rules. And for example, I'm going to, for earnings especially, I'm not going to, for example, sell a naked put on Apple, even though there's the implied volatility of the earnings, because for earnings themselves, I have a very tight strategy that I want to respect and that I want to follow. And even though, for example, right now I was thinking about it, there are some great premiums because now the earnings are coming back. So now there are plenty of premium for mid-July or something. However, for the earnings, I'm going to sell a strangle on stocks that usually don't move too much during earnings the day before earnings, and so as to buy it back the next day. And for this, I made a video on the subject. I use a website called optionslam.com. I don't know if you know it. It has this EVR rating where basically the website, they look at all the past earnings of the stock, and then they're going to rank it on a scale from 1 to 10, 1 being it's really not volatile during its earning announcement, and 10 being very volatile during its earning announcements. And me, I'm going to trade earnings for stocks that have an EVR of less than 2. So it allows me to sell strangles on stocks that usually don't move a lot during earnings. And I'm benefiting from the big premium. And honestly, that's the only way I'm trading earnings. After that, I'm not going to start, especially for tech stocks like Apple, Zoom. I mean, I got burned on Zoom last year, and I'm staying away from tech stocks because they're usually too volatile during their earnings.
So you'll look at stocks on optionslam.com that even if they're not on your watch list, and then I assume they have a proprietary figure that you'll look at, and then you'll also compare that against the implied volatility rank for that underlying. And I assume that the higher the higher the IVR number on that underlying, and the better the liquidity on that underlying, and the lower the earnings move for those underlyings, that will then give you the best opportunity to sell a strangle on that specific underlying. Is that accurate?
So basically now I have a watch list that is really specific for earnings, where I have around 15, 20 stocks in it that every earnings season, I always trade them. I always put a strangle the day before, and I calculated actually like for in a span of 8 months, I took 38 trades and I had a win rate of 90% on those 38 trades. And it's always the same stocks that I do, and I just do that, selling a strangle the day before and buying back the next day, and it works about 90% of the time. And the key there is really to focus on stocks that are not volatile a lot. I mean, how do you trade earnings? Because that's my way of doing it. That's the way that I found, but maybe you do it in a different way.
For me, with earnings, I generally do stocks that are on my watch list, and I just go a little bit further out with the strike price selection, because I know that there's an increase in the amount of available premium due to the binary nature of earnings. But I don't look at stocks that are like outside my watch list and then sell. Although I think that that's a really great strategy, but I don't sell strangles. Instead, what I do is I tend to sell expirations that immediately expire on the Friday after the earnings announcements. And I also tend to sell some calls, sell some puts, and also go slightly farther out than I usually would, because you're compensated for assuming more risk due to the binary nature. And earnings are actually my most profitable times.
Same.
So I love it.
But the thing is, with stocks, for example, like Zoom, those are killers. I mean, they can, for example, when I was trading, like it was, I think my the second or third earnings season that I was like really doing like, properly, like, okay, I have my strategy, I have my watch list, I'm just doing this, boom, boom, boom. With Zoom, for example, I remember it was in September, if I'm not mistaken, the stock went so low. I mean, it just dropped completely.
Yeah.
It can crush all of your previous gains. And especially with, when you sell options, obviously you collect less money compared to the losses that you're going to have. It's going to be, obviously, you're going to have bigger losses compared to your wins. So when you have a very bad loss, I mean, when you're wrong on a strangle, you really won't. Like, it can really go bad quickly. That's why, for me, the most important thing, and that comes down either to the portfolio or just to the earning strategy, it really comes down to really choosing the stocks that we're trading and not going for stocks that are too crazy. Even Zoom, that doesn't seem like crazy. During its earnings, you can check for free on optionslam.com. I mean, you can see how the stock moves. It's just like, I don't want to be in there, especially selling a strangle.
Are you mostly selling strangles, or are you mostly selling iron condors for earnings?
For earnings, I'm going to go for strangles. I'm going to go for strangles to maximize really the money that I'm making. And I'm allowing myself to sell naked options there and not, iron condors or like usually vertical spreads like in, normal times, because I'm only there for a day, less than a day. I'm literally selling usually 20 minutes before close. And 85% of the time, 90% of the time, 5 minutes after opening, I'm out for the strangle at least. So that allows me to be really there for short term. After that, I could be unlucky, sell my strangle, and the next day the stock market crashes, and I'm in there with a short strangle. That could happen, but I'm really making sure that I'm not exposed in a low IV environment with naked options, and I'm just choosing those moments where I'm exposed so as to make sure that first I'm maximizing the money that I'm making, because earnings are the opportunities, and it's absolutely the same with you. Earnings are my best moments during the year. I mean, that's my most profitable moments, because you literally make money after money after money, and you can do that each and every single day. I mean, it's pretty amazing earnings, but you still need to be careful about the stocks that you trade. I mean, it's too sad sometimes when I look at all the stocks that are going to have their earnings, because there are like hundreds of stocks, and I just end up trading like 15 of them, because I don't feel confident trading all of the 85 that there is, because they're too volatile and I don't want to take that risk.
Well, now this is interesting, because your earnings trade is kind of like 0 days to expiration trading. Yeah. And I usually get like a few emails a week asking me about like 0 DTE, because I know that there's an incredibly high win rate, and I know that some of my friends do it and they do very well. And but what are your thoughts about 0 DTE?
So yeah, I've been in contact with some people that doing, they're selling a lot of iron condors and SPX, 0 DTE. It's not, I mean, for the very short term thing like this, the only thing that I do of that kind is for earnings, where I'm going to sell, the day before, and then I'm going to close it on the day where it expires. But for strategies like the 0 DTE strategies, where people sell an iron condor on the SPX, personally, I haven't tried it, so I cannot talk in terms of results and everything, but I can imagine what it is. It can basically, and I'm sure you think the same, it's like, 95% win rate. You have those wins almost all the time, and then one day you get crushed like badly, and
I think that's what higher. It's probably higher than 95%. I mean, obviously it depends upon which underlying. You're probably, I would assume if it's 0 DTE, they're probably using like SPY or SPX, because then it has like the 3 expirations. But depending upon the strikes that you use, I would think that, but I think that you could potentially get like a 98, 99, but as long as you can control the risk, right?
Yeah, and I feel it's kind of hard. I mean, I don't know, I had been approached by someone who was building like a robot for basically trading 0 DT, and I was like, that's don't do this. Like, that's a bad idea. You're going to get crushed. Like, if you want to do that, like, just focus on the money, on some money that you can afford to lose, and you make sure that you really control your risk. But it's I think it's an easy way of getting burned, especially when you're starting with options, because you hear like 0 DTE or, for example, earnings. That's something that is very short term, like instant gratification, and that's why I love it also, because you put your trades during earnings, and the next day you wake up, boom, you made money, and that's amazing. But that can also have its negative sides, and it can really be hurt like big. So talking about starting with options, what is for you the nice first steps to do when you start with options?
When I start with
when someone, let's say a beginner, someone who doesn't know anything about options, what do you think should be the first step?
Okay, so this is actually like really interesting. I think that it obviously, like, getting set up with a legitimate broker, which really isn't that hard, because pretty much all the brokers are, it's like a commodity, whether it's Fidelity, Toss, E-Trade, Vanguard, Tastyworks, etc. Schwab, there's like probably 7 or 8 of them that pretty much are, it's very, very easy. So then what I would do is I would get comfortable with anywhere from like 10 to 20 stocks that you want to follow, and then just start watching how they trade while also observing the market and how things respond. If the S&P is down 10, like, or if the S&P is down 1%, see how those stocks on your watch list move, like what the beta is on each of those individual stocks. Then look at how the option prices move relative to the changes in the underlying stock. And then I think it would be important to potentially paper trade a little bit and maybe open up like a small account, because I think that the most important thing for traders when they get started is to make sure that you obviously watch your size and realize that you should be in this for the long haul. You're not going to, with a $5,000 account, you're not going to get rich by selling options. But if you try to earn too much money, then you're going to end up losing money. So it's better to earn 3% a month, and then 10 years from now, turn that, add money to it from your work, from your side hustles. And instead of having 5,000, you learn a legitimate strategy, build up your trading capital, and then you have a great nest egg for retirement, as opposed to trying to hit home runs and, eventually losing your money. I really think that the more experience I get, the more I simplify things. And I think that trying to be distracted by so many different things and so many different strategies, I keep things so simple now. I mean, it's just kind of like, hey, I sell either naked puts or naked calls or naked, or credit spreads. And okay, yes, it's true. Like some of my roles can be a little bit intricate and a little bit, like challenging, but it's more that I understand the options from experience, and where it just becomes like incredibly simple. And I think that the most important thing is knowing when to trade, when not to trade, when to take positions off, and how to not get greedy and how to not get anxious. Because the big problem is right now with like a low VIX, you might feel that you're not putting money to work, and that might make you anxious. So you might make a trade that you shouldn't make. And there's a high chance that you're going to make money on that trade. The problem with that is that then starts you going down a slippery slope where it reinforces negative behavior. And then the next time you'll be more likely to make a trade when you know that you shouldn't. So I think that for new traders, they shouldn't put too much pressure on themselves. They should try to keep things as simple as possible. Try to learn and understand that in the grand scheme of things, when we talk about market crashes, the biggest enemy isn't necessarily where the current market price of the stock is relative to your strike price. The biggest enemy is actually a massive volatility increase from having the VIX increase from like 15 to over 60 in like 2 weeks. Because even if you sell a put option that's very far out of the money, like let's say Amazon, you sold like a 2,400 put, and if Amazon falls from 3,400 to 2,700, but the VIX increases from 15 to 45, even though your put option is still about $200 out of the money, the difference between the current market price and your strike price, you're still going to be showing a massive loss on that put option because the VIX increased by multiple times. So I think that's really important for new options traders to understand, where they think, okay, well, my option is still 10% out of the money, but they need to understand how volatility impacts the prices of the options that they currently hold. I think that's very valuable, because you can go from having 40% excess liquidity in your account to having like less than 10% in 1 or 2 days if you trade too large.
Yeah, exactly. And I think it's also about, especially when you start, and I think that's maybe it's the culture now, but when you go on YouTube and you type like, what are like reasonable returns that I can achieve trading, you're going to see things that are insane. Like guys, like, it has escalated from like saying that you make a grand in a day to making 300% per month or something. Like there's no limit to how far these guys are going to go. And I think it's about first of all, putting things in perspective. Like if you manage to reach, let's say, just 20% a year, just 20% a year for 20 years straight, you're already doing better than most of the investors that have ever lived. Like, first of all, like, I think it's important to replace things in the context, because, we tend to forget that, like, it's, yes, okay, it's great to make some money and everything, but first of all, look at it in terms of percentages, look at what the best people in the world are doing. And first of all, it's all about longevity in that game. Like, it's who is going to be there in 20 years, in 30 years. Because if you make 100% and then you're out of business, I mean, you're just, an idiot. Like,
You're
the
just
game,
optimistic.
yeah, the game is to be there in 30 years and still win, and for that, and that's the fine line between, obviously you want to beat the market because that's what you're actively investing for, but you also want to be, risk averse and be aware that, okay, already 2% a month or 3% a month or just 1% a month, 1.5%, in low IV environments, it's already amazing. Like, so far, this year is a very good year for the S&P, but in a normal year, if you're just making 2% a month, it's already amazing. So
The issue that I see with that is survivorship bias, where the people who end up blowing up their accounts, they kind of go quiet and then they drop out and then you don't hear from them. So if you're earning 15 to 20% a year, and then you hear of someone who earned like 100%, and then 3 months later, that person blew up their account, that person drops off, but they're immediately replaced by someone else who claims to have earned like 100% over the past month. And I think it's almost like the Instagram effect, where girls feel more pressure to be perfect and to use the perfect filter and cosmetic surgery. It's very hard to ignore all the noise when, even though in reality, most people are losing money when they're trading, but you don't see that because people don't actually own up to it.
Yeah, but it's mad because, and I very much agree with you. It's I think that this is like a cultural thing that unfortunately happens. For example, I have a friend of mine who invests in the markets, in stocks. He has some dividend stocks, and he also has some cryptos. And he started like that portfolio of stocks and cryptos like beginning of 2021. And I was talking to him like recently, and I was like, "So how's your portfolio doing?" And that was at the time when cryptos were like at their all-time high. So obviously he was like, "Yeah, my cryptos are like up, something like 50% or something, and my dividend stocks, meh, they're not doing that great. They're only up like 10%." But 10% on stocks when you're only in May or April, I mean, it's amazing. It's an amazing return to have already without doing anything, And it's obviously comparing this to a return of 50% with cryptos, but this is not the benchmark. Like any of those guys on YouTube, none of this is the benchmark. Like, it's better to look at people that actually have done it, and what is actually doable and achievable, or at least what is the average market returns, and base yourself on that. And if you're like, well, if I can beat the average market returns, well, I'm already doing better than the market on average. So it's already doing great. You don't need to have 100%, 200% a year. And even if you try, at some point, you lose everything because you're taking too much risk.
Do you have any thoughts on like bot trading or automatic?
So automatic trading, I had built one with a friend of mine that was based basically on standard deviations. And that was based on standard deviations in a way where he was averaging down, and 99% of the time, the problem with that's called the martingale strategy. And that strategy is just based on standard deviations and probabilities. 99% of the time, you're going to make money, and 1% of the time, you're going to lose everything. And so we had dabbled a bit into that. But as what we hear usually in terms of robots and Forex and whatever, I've never, ever experienced something that worked properly on the long term without having a huge risk. Because if it works, usually there's going to be like a strategy like the martingale strategy, where, if you lose everything. That's, if it works, it's usually like this. So personally, and honestly, like, I mean, I don't know about you because I understand that you come from different professional background, but coming from a very simple retail background, I've looked into technical analysis, Forex, bots, I mean, I've never ever seen anything that worked apart from selling options. And bot is the same thing. I mean, I've never seen any bot that worked, or if they worked, they had something that they were hiding for a good reason.
I agree with you 100%. Where I think that bots are attractive because people don't want to take responsibility, and also thinking consumes a lot of energy and it uses up a lot of like capabilities. Like if you engage in an activity where you have to concentrate all the time, it's mentally draining. So if you can automate something that does the work for you, then it's inherently extremely attractive. You save time, and then you also, if you lose money, then you can point the finger at the bot or at the computer and say that it's their fault, as opposed to taking ownership. The problem with that is I am in agreement with you. I think that people who rely on on bots, and those people who trade, who only like do bot trading, I think that they're in for a very rude awakening, because I think Tom Sosnoff used to say this, and I don't know if he still does, but I agree with him, where brains over bots. There are so many different inputs in the stock market that you have to be able to aggregate all of the available information and then make decisions in real time, because you might be preparing or programming a bot based upon historical data. But then if you look at something that transpired in March 2020, that had never even happened before. Even nothing even close to that happened in the order of magnitude that it happened. So I think that it's really risky to farm out the trading responsibility to a bot. And I think that it's really just asking for trouble.
Yeah, I think on the long term, I I I don't see how we're not going to arrive maybe to a point where it's doable, to actually automate things from a portfolio perspective. Because when you look at the level of technology that we're reaching on a, just on a yearly basis, the progress that we're making, I'm sure that at some point we're going to be able to compute all of those inputs and put them within a machine learning tool and just have that trade instead of us. So far, I haven't seen, at least, I haven't touched and experienced that firsthand. So I can't say that it's working or anything like that is working, because I've never ever experienced it. I've had actually I've seen Option Alpha is developing this auto trading platform. I think it's an auto trading platform, but he had, by the way, reached out to me, so I would promote his platform in a Facebook group that I also have. But it's funny, it's interesting that he's going down that route, and I'm curious to see how well it's working, because I think that we will be able at some point in the future to make that work, but I don't know if that is actually the opportunity that is going to work. So I'm curious to see how it's going to go for him, and I wish for him to do well, but I don't know. Have you seen that?
I have. I don't believe in it. That's my gut feeling. I do think that it's, if you want to use a very simple strategy, like selling covered calls on the SPY, or selling calls if a specific underlying increases in price by 5% in like one day, and then you want to sell a call option on a covered call that's like one standard deviation out, something that's like very simple, that has like very narrowly defined inputs. I think that a bot would be perfect for that, and I think that actually a bot in that respect would be better than humans, because the instructions are so simple that it really just comes down to like making sure that there are no errors. But the way that we trade, which is very similar, where you're looking at like the recent trading range, you're looking at your watch list, you're evaluating like what's the best opportunity based upon your perception of the overall market and the watch list. You're making a decision whether you want to sell calls or sell puts. You sold a put, you want to then balance out the portfolio delta. I just think that there are too many inputs where it's better to be able to process the information. Because think about it this way, like your brain is amazing. Like right now, there are probably like thousands of like inputs and signals that our brains are receiving. But we're focused on each other at this on this call, right? Like, there are sounds and colors and all that stuff. And we're focused only on the most important information, which is us talking to one another. The issue is that a bot is unlike your brain, where it's unable to cut through all the BS and focus on like the 3 or 4 things that are the most important, while simultaneously factoring in all of the aggregate information to arrive at a split second best decision. So maybe in the future, for complicated option strategies, they'll find something that I'm comfortable with, but I don't. Yeah,
Maybe not yet. Yeah. The thing is, for example, and to play a bit the devil's advocate, as much as our brain is amazing, there are now some, and AI is a buzzword, but let's say machine learning algorithms. There are some machine learning algorithms that put results that we don't even understand ourselves. We don't even understand the processes that they went through so as to arrive to those results. And when we talk about, for example, AIs for industries, like in any given industry, or like subjects like predictive maintenance and stuff like this, there's sometimes some results that we don't even understand ourselves, which shows that it starts to take over us in terms of all of those inputs that are being aggregated, and we cannot follow them after that. At some point, we're losing the race against those machines because they're just too strong for us. And that's why I find it hard to believe that it's impossible to do what we do. And I understand your point, because I think that's something that you mentioned in your last videos, is that it's more, especially when it comes to rolling, it's more of an art rather than a science. And I mean, for sure, there are a million ways you could roll a losing trade. There are a million things that you could do different, and the way you roll a trade is probably going to be different the way that I roll a trade. For example, I understand that you like to adjust your strikes. I very often don't adjust my strikes when I roll. And I find that, actually works like great. But you see that it's already 2 different ways for the same action with the same philosophy. So I understand in that respect that it's hard to make a rule, a black and white rule, out of like art, quote unquote. But I find it hard to believe that at some point in the future it's impossible, it's going to be possible to make like, not a bot, because it won't be a bot. It will be a machine learning algorithm that will take a lot of inputs. But for the moment, what we see is bots. It's like, black and white rules. It's like if A, then B. It's a bot. It's not like a real proper AI with a neural network and everything built inside, like a proper machine learning algorithm.
Like, for example, I think it would be foolish of me to say that I don't ever believe that a bot or a computer will be able to trade better than a human. I think that's wrong. And remember, like, they've been able to teach computers how to beat humans in chess. Computers are better drivers than human beings exponentially. I just think that the issue with bots is who's inputting all of the rules. It's retail traders. And for the most part, many retail traders are not overly profitable. So if you had someone like Fidelity, or even if like Tastyworks worked on a bot with all their data scientists, me personally, I would feel more comfortable where I can go in and look at all the inputs, and I would feel more comfortable, trying that out versus having anyone just go in like a retail trader. Maybe they have like, $1,000 or $2,000 and they've been trading for a few months and they're just messing around. And then they think that this great strategy is going to beat the market. So I think it's early, but it could happen for sure.
Yeah, just for the moment. I mean, the thing is, obviously when you hear, and that drives me crazy, because when we hear about AIs in the Forex market or wherever it is, what we really mean is a bot that has a black and white rule, like if A then B. That's not an AI per se. That's not like what machine learning algorithms are. And that's very often what is being mistaken, and on purpose, from a lot of people, so as to sell their thing, and that's absolutely being done on purpose. And you mentioned something, and going away a bit from that subject, what do you think is the minimum in terms of capital that someone should have so as to be able to properly trade options? I have my idea, but I'm curious to hear your opinion first.
Okay. So if you're young, then let's say you're like younger than 25, trading with below like anywhere between $2,000 or $5,000 is fine, because your goal is to learn a strategy and a skill that you can apply for the rest of your life. I think that would be great. But like realistically speaking, I think you'll need about $15,000 to $20,000 in order to just maintain the persistence or the desire to like wake up every day and spend anywhere from like 20 to 40 minutes and continue trading. Because if you have like $3,000 in your account, even if you make 3% a month, it's not really that much money. And then if you're spending like 20 to 40 minutes every single day, it might be difficult to keep that motivation and just continue waking up every single day. Because yeah, but I do think that in general, around like $15,000 or $20,000 is perfect. But if you are highly motivated, anywhere from like $2,000 to $5,000 would be great. What do you?
I think, I mean, exactly. Obviously, it depends on the person's capital, and not everyone has, like, for example, 20K to put like trading account, and absolutely fair. But I started with, I mean, I think my first option trading account, I started with like 1,000, and then I put more into it. But the problem with trading with, like, let's say between 1 to 4, 5,000, is that you're going to be very limited in terms of capital, in terms of positions that you put, especially if you sell options. Because when you sell options, and let's say you want to do things like we were talking about, selling a wide credit spreads, well, your maximum loss technically could be like easily of $1,500 if you sell a wide credit spread on a stock. And if you have just 3K, well, you're already 50%, like buying power used just for one position, compared to if you have like ideally between, as you said, 15 to 20K, that's getting a lot easier, because now you can have like 4, 5, 6 positions without putting yourself in too much danger on the short term. So I'd say the strict minimum, I'd say, is like 2,000. But if you can, I mean, like, scale that up to like 15,000, that's where you can start, doing things like properly having a portfolio, maintaining this, like going on a daily basis, checking if you can roll some trades or putting some new trades on. And that's where you can have this consistency, and you can be more active. And honestly, it's a lot more fun.
Great. Is there anything else that we didn't talk about?
I had written some stuff. So do you dabble into leaps a bit? Do you buy some leaps?
I usually don't. What I'll usually do is be a little bit more aggressive on my strikes, and even potentially if I think something is oversold, I might actually sell an in the money put option. I don't really like selling leaps. I've modeled it out, and I know that there is a potential for great upside on it, but I don't really like buying options with the expectation or the hope of making money. I would prefer to sell an in the money put and actually capture some of that extrinsic, as opposed to buying in the money leaps. But I will say that if I was forced to buy options, then buying deep in the money leaps would be the one strategy, that buying call options deep in the money leaps would be the one strategy that I would engage in.
Yeah, absolutely agree. I mean, I think exactly the same. If I had to buy options, I would buy deep in the money leaps, because deep in the money, they're going to have a lower time decay, so we're going to lose less money on a daily basis. They're going to mimic the stock a lot more, because the delta will be higher. So you're technically almost trading the stock, but you have leverage, and you don't have the downside, at least as much downside as buying the equivalent of shares. So it's quite nice. I did a lot of poor man covered call at some point. I had done some videos around them. So I was dabbling into this, and I was buying some leaps and selling calls against that. That was nice, but still buying options really doesn't feel natural for me. I mean, there's something that I don't like about buying options overall. Just having that time decay that works against me, honestly, it's a pain. When you go from having it in your favor to having it working against you, it changes a lot.
Awesome. All right. I think this was a really great call. And is there anything else that the viewer should know?
No, I mean, I hope that we brought value, and I hope that maybe it answered some questions, or it brought up some new ideas. And of course, if there is any question, like, I'd be happy, and I'm sure you are too, to answer any question that anyone might have, and that'd be a pleasure to help.
Great. All right, JC, thank you so much. I hope that we
Thanks
added
for having
value
me.
to our viewers and to your viewers as well. And I think this was an amazing call.
Yeah.
And yeah, I think that people will find it very valuable. So thank you for your time, and I hope you have a great night.
Thank you so much, David, for your time and reaching out to me in the first place, and hoping to do that maybe in the future again.
Thank you, JC. Take care.
Have a good one. Bye-bye.